Today we're over here at ZeroHedge.com where WeWork files for bankruptcy, roiling already stressed office CRE markets. Hey everybody, thank you so much for checking the channel out today. My name is Agabus. This is your financial education channel. As you all know, interest rates have gone from 0% to 5.25% to 5.5% in no time short. And a lot of companies are starting to see what that lag effect dictates on their balance sheet. Now with a lot of companies, they have to pay off these bonds, but the bonds are interest-only payments. So as interest-only payments now have to start getting refinanced in the market, current interest rates are significantly higher than they were only a couple years ago. This may start to turn those zombie companies into dead companies here in no time. Let's take a look again at what Zero Hedge has to say regarding WeWork. Almost exactly 2 years after going public via a SPAC, WeWork, the struggling co-working startup that once held a valuation as high as $47 billion, filed for Chapter 11 bankruptcy protection in New Jersey federal court on Monday. Having spent its entire life burning up huge amounts of cash raised from investors, a total of $13 billion raised in 22 rounds, much of it from SoftBank and SoftBank's Vision Fund. Now to put some of this into context, WeWork, valued at $47 billion, is considered a large cap company with a market value between $10 billion and $200 billion. This is from finra.org. You can see the price depreciation over the last couple of months here, losing 99.9% of its value in 2 years. Yuck. In a press release, the company said it struck a restructuring agreement with creditors to drastically reduce the company's existing funded debt and expedite the restructuring process. The bankruptcy is limited to only WeWork's locations in the US and Canada, according to the company. It reported liabilities ranging between 10 to $50 billion. In a press release, the CEO says, "Now is the time for us to pull the future forward by aggressively addressing our legacy leases and dramatically improving our balance sheet." I would concur with that statement. He also says, "I am deeply grateful for the support of our financial stakeholders as we work together to strengthen our capital structure and expedite this process through the restructuring support agreement." WeWork had shown for months now that it probably wasn't doing so well. The first that took place was in August when it started in a 10Q filing that substantial doubt exists about the company's ability to continue as a going concern. The company was hemorrhaging cash and liquidity was running thin, and Tolley said in September that the company would seek to negotiate terms with our landlords, and parties in negotiations we expect to exit unfit and underperforming locations and to reinvest in our strongest assets as we continuously improve our product. Then in October, WeWork skipped interest payments of $95 million on one of its bonds, triggering a 30-day grace period. That's not a good thing when companies start not paying their debt. Listen to this. As of June, the company was leasing 20 million square feet of office space, more than any other company in the United States. Now, WeWork might come out of bankruptcy with a much smaller office space footprint across North America. However, this scenario could spell trouble for the already struggling office space market, potentially unleashing a wave of additional supply. This is a pretty significant event in the current I can't say recession, but in the current cycle of the markets, let's call it that. We'll see how long and how far this commercial and residential real estate market lasts until something big breaks and the Fed has to do emergency drops in the interest rates. We'll continue to stay on top of the real estate market. Thank you so much for listening and checking the channel here today. Looking forward to seeing you tomorrow. And as always, make sure to stay informed, stay inquisitive, and stay subscribed for more. We'll see you tomorrow.